I'm going to walk you through HSA and 401k. You might have heard these terms before. You might even be using it, but I think there might be one or two things that you didn't know that you could do with it. You might learn something new. I have both. I've used both in the past. That's my experience with it. I was researching this to get more information, more background information. I learned a lot more. When I share all that information with you. This is this is mainly if you're employed. If you're not employed, there are some things that you can do, but not to the extent that somebody going through their employer would. So, hello, mine. My name is Crystal. I talk about stuff I know from getting laid off and just kind of navigating through that time of not having a steady income and trying to think of ways to save, and then now working again, and then just being more mindful of where my money is going. Okay, let me see if I can share this information. So this was one of the topics on my list to go through, is to go over what I know about each of these topics. And if it can help you, then that'd be great. We'll start with HSA and then go to 401k. I think both are kind of interesting. So let's start going through this. I'm going to talk about HSA first. HSA stands for Health Savings Account. So HSA, let me go to my cheat sheet. The Health Savings Account, it's known as the MMA. This is a long one. It was created under the Medicare Prescription Drug Improvement and Modernization Act of 2003. So it's not that old. So as the name might imply to you, it was supposed to help as part of Medicare. If you're on Medicare, you're not actually allowed to get an HSA. But it does help everybody else. And hopefully at some point, it will help Medicare people. The HSA was originally intended to offer tax savings to cover our medical expenses. So what's the big deal with this HSA thing and this whole tax thing? HSA, if you're going through your employer, you determine how much you want to contribute to the HSA over a year, and that money is taken out of your paycheck, an equal amount over each pay period to reach that total. The money that is taken out is before you've been taxed. So that lowers your taxable wages, which could help when you file your taxes because now your total earnings are less. Quick example, if you contributed $1,000, $10,000 you're earning for a year, and it lowered it down to look like you're earning $9,000. But what happens is they're affiliated with an HSA program. That money goes into that account. You get a debit card to draw funds against. If you happen to pay for something out of pocket, you can always get a reimbursement. You can use it to help your deductible. You can use it for your co-pays. You can even go to a pharmacy and get Band-Aids. There's a whole list of medically approved items that you can get from a pharmacy. Or if you use Amazon, they have the list of the HSA items too. It will not let you spend it if it's not approved. So HSA rolls over year after year. So you put the money in and you happen to not spend it for that year that you're rushing to try and get rid of it. It rolls. You have it forever. It's always yours. It stays in an account. The next year, if you apply for HSA again, the money rolls over, and whatever new that you put in there goes with it as well. There are requirements in order to be able to use the HSA. So regardless of how you're setting up the HSA, you must be in a high deductible healthcare plan, HDHP. It must be a high deductible plan. You can't have any other medical health insurance. You can't be enrolled in Medicare. If you already have an HSA, it's okay, you can keep it, but you can't request a new HSA so that you're in Medicare. Whatever. You can't be claimed on someone else's taxes as a dependent. And that's it. As long as you meet those criteria, you can have an HSA, and that's regardless of employed, not employed. It changes year over year, but there is a limit to how much you can contribute to an HSA. If you're going through your employer, there's a potential bonus. It is possible that your employer contributes to the HSA as well. It's not money that they're going to hand you otherwise. That's available day one, and that stays in the HSA. You don't have to give it back or anything like that. You use it for your medical. I had HSA, my previous employer, my current employer. As it's been available and I've been able to use it, I get it. I always put in at least how much covers my deductible. My deductible is usually like 2,000, 3,000. It gets easier over the years once the kids are off the medical. So day one, I can go to the doctor. And then, yeah, throughout the year, I use it for my copays. I use it for my prescriptions, all of that. It's very helpful. And it is pre-tax money. So you're paying with that card, and this is money that hasn't been taxed. You're not going to report it at the end of the year. When you file your taxes for next year, it lowers your taxable income. So that is a bonus. If you're not going through your employer to do your HSA, it is possible that you could still get it taken out through your wages. Find out from the HR department if they'll allow that. While you're talking to them, ask them if the employer offers a contribution for HSAs, and if so, would they still allow the contribution if you're not going through them for medical? For the unemployed, or if you're not going through your employer, you can still get an HSA as long as you meet the requirements. In this case, you can go to like banks and Google it, which institutions have HSA accounts. In this case, since it's not going to be deducted through your wages, you're just going to put in whatever money you have. It's already been taxed, right? At the end of the year, you can report that against your taxes and it counts as a deduction, regardless whether you're doing the itemized deductions or not. It still counts. There is another thing that you can do with HSAs that are not like medical related. This is a tax-free thing, and even, lowering your taxable income, something that you can deduct for your taxes if you're not going through your employer. So an HSA can be used for medical, but you can put money into an HSA, and people have been using HSAs to do investments. They treat it like an additional retirement account because you get the tax advantage. So I thought that was kind of cool. It's another neat thing to do with HSAs. I mean, you're getting a tax savings either way, whether you're going through the wages with your employer, you're having to report it on your taxes. All right. So that's your thing. So, I mean, individual or family, you could put that money away and then either just let it sit there and ride, and enjoy the tax break that you're getting year over year. Or you can invest it. So now we're ready to talk about 401k. Are you ready? The 401k was enacted in 1978. You should be able to remember because it's part of the name of the bill. The Revenue Act of 1978. It is named after the Internal Revenue Code 401k, that whole section. But I think it's not as big of a thing now as it used to be. I always thought this was just a government thing, but pensions are a way for the employer to put money away for their employees' retirement. And they had done this, had been doing it, whatever, but it's expensive for an employer. There's a lot of rules around it, la, la, la. That section, the 401k, was created so that employees could have more control over saving for their retirement. They were given a tax incentive to put money away for investing, and the investing would be what becomes your retirement savings. You used to have pensions, and then the 401ks came along, and over time, pensions have kind of gone away, and it's more on the employee to save themselves. So this one is no mas for the unemployed. Sorry. If you are not employed, you cannot get the 401k as an employer-based plan. So if your employer offers it, you can go through them for a 401k. You determine an amount that you want to put away for the year, and they divvy that up over your pay periods in equal amounts. It comes out of your wages, pre-tax. It lowers your taxable income. So when you go to file your taxes, your income threshold is lower. Your employer will have an investment firm that they work with. The money goes into that account and you make investments, stocks, bonds, things like that. That's the only thing it does. It goes for investment. You can't stick it anywhere else. So it goes into whatever the investment firm is, and it will have a default setup. You could leave it like that. They figure out what's your age, and then there's usually certain funds that are meant for specific retirement group. So based on how many years out you are, they'll give you more aggressive, less aggressive funds that they put you in. And there's a different percentage of stock bond ratios. It's your money. I would encourage you to go to the investment fund site and learn about what is in there. See how your funds are doing at any time and change them up. There's usually classes you can take. You are paying for that in some manner, you directly or your employer. You are giving them money for them to be investing your money wisely. You should take advantage of finding out about these investments. They're your investment experts, so put them to work. Let them earn their money. There is a limit to how much you can contribute. After you're a certain age, you're allowed to contribute a little bit more to catch up. It changes every year, so whatever the limit is for this year, next year they will change it. It goes based on the COLA. There is a potential bonus with this one as well. Your employer might contribute to your 401k. Check your documentation, talk to your HR people. This is money that you're not going to get otherwise from your employer. When you look at your benefits plan, if they're contributing, it'll say they'll match a certain percentage of whatever you're contributing. So for example, my employer will match 5%. It's not 5%. That's the way it's worded. It will match 100% of my first 3%. So they're matching a full 3%. And then the next 2%, they will match 50% of that. So if I contribute 5% of my earnings into a 401k, they will match me 100% for the first 4%. I'm 4%, 100% matched. That's good. Make sure that you check into all the rules and regulations of what your employer is doing with that 401k. There could be a clause that says that they are vesting their matches. So vesting would mean that they're putting a time limit on when they fully give you that money. They might say, we vest up to 4% after 3 years, which would mean that if you leave before the 3 years is up, anything that they had matched until then, they take it back. It's not yours. So just look out for that. Until retirement age, when you put your money into the 401k, if you take it out before that time, not as a loan, like if you just take a disbursement. So if you take money out of the 401k, you are going to pay for the taxes that you didn't pay on it because it was pre-taxed, you hadn't been taxed yet. So now they're going to tax you. And in addition to that, if you don't qualify for whatever they count as a reasonable reason to take the money out, then you get hit with a 10% penalty as well. You'll get a form at the end of the year. You're not meant to take it out until you retire. You can take loans against it. If you take a loan out, it comes right out of your wages. They would figure out whatever the life of that loan is, and then they would break that into equal payments, and that comes out directly from your wages. You can't do anything about that unless you want to pay it off early. And if you leave your employer and that loan is not paid off, you have to continue making the payments. If you don't, they will write off the loan and you'll get hit with the tax and you'll get hit with the penalty. Plan to put it in there and let it sit, let it stew, let it collect some good earnings. So unemployed, or just you don't want to go through your employer, or you don't want a 401k, you have other options. So IRAs, individual retirement accounts. You don't have to be employed to have them. Anybody can get them. You can set them up directly with a bank, a brokerage, financial advisors, any of those flavors. Some of them you can get a tax deduction when you file your taxes. Some of them you can't. One of the advantages is that whatever you're earning through investments, you are not taxed on that potential income until later in life when you withdraw the funds. Traditional IRA is usually tax deductible. You have to check. Roth IRA, it's made with after-tax money. There's another one. SEP is tax deferred. And then there's spousal IRA. So if you're not working but your spouse is, you can contribute. They all have similar limits. These change year over year. In some cases, when you're paying in and you're not getting the tax deduction at the end of the year, like Roth IRA, you're taxed on the money, that's the way it is. But the money that's growing through investments, you're not taxed on that. And when you do take it out later in life, you're not taxed again. Specific to the Roth IRA, if you do make withdrawals before you're 59 and a half years old, you'll get taxed, and you might get a 10% tax hit in addition, like the 401k. Check all the rules. Whoever you go through, your bank, wherever, to get this, just make sure you ask questions. They should be able to explain all that. Can I do tax deductions? Am I taxed on whatever I've invested? Can I take the money out for emergencies? If I can, what are the repercussions? And am I paying taxes on this money when I do retire? So, good stuff. And you got some good info. Thank you for watching. I appreciate it. I've enjoyed finding out more information about this, and I hope it's helpful for you. I hope you can use it. If you're not already, please look into it. HSA, I think, is fantastic, helping with the deductible and then being able to use it for your expenses. And future videos, I am going through budgeting. I actually split this video because I was going to do like a little blurb on 401 HSA, and it grew into something bigger. And my budgeting video is already way longer than it needs to be. But I wanted to get this video out here. We're going to start signing up for medical any day now, see what's available in there and what you can do. And that's the whole shebang. Check out the links. If you have some links that you can share, please do throw them out in the comments. Any feedback on 401ks that you have, HSA, if you invest with HSA, spill. I'd like to hear. This is a completely new thing for me. I didn't know about it until I was researching it. So it's very interesting for me. Yeah. So comment what was good, what was not so good, any action items for me, ways I can improve, any kind of constructive criticism. Thank you. I really appreciate you being around, and I look forward to reading your comments as well. So goodbye. Moin moin. I'm Crystal. Blah 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 blah. Of course, now I can't find the damn thing. Where is it? Specifically, exclusively, and undeniably. When I retire, it will invariably, it will be higher. Alternatively, just invest in gold. Then you gotta have some place to put it. So to like wrap up this rainbow. No, this is fading fast, isn't it?